Giles, shares in the big London-listed miners have been a terrible investment this year as commodity prices have fallen. Yet one, Anglo American, stands out as being particularly badly hit. What is it that they have done differently? Is it the quality of the assets or perhaps the quality of the management?
Well, I mean, start with the assets. Well, 5 big product lines: iron, coal, copper, diamonds, manganese. None of these have been going up. In fact, and when you throw in platinum, which has been hit by political issues as well, you can't really pick a worse product suite. And even since a rather downbeat half-yearly update in July, these prices have carried on falling. Iron, for example, is now at the lowest it's ever been recorded on its index, from 60 then, which was pretty low, to 40 now. So it's selling stuff that is falling in value. But secondly, it doesn't have the best assets. For example, in 2008, terrible timing, it invested in something called Minas Rio in Brazil, a massive iron ore asset. It's put about 13 billion into this. It's still not the best in class. And in today's investor presentation, there are hints that even this, in which they've sunk so much capital, might go. So pretty lousy timing, not particularly good running of the company, and not best in class assets adds up to a terrible investment story.
Now, you mentioned there'd been an investor presentation today. What was discussed at that? Presumably they are now outlining what they're going to do to fix this.
Yes, exactly. I mean, their problem can be boiled down to one word: cash. I mean, they make about 6 billion when times are reasonable from their cash flow, operating cash flow. That's about the same as their capital investment. So once you pay your interest, dividends, tax, you're down 2 billion a year. So that's been adding to their debt. They need to stop that. Their debt's about 13 billion on a net basis. So what do? You've got to sell assets. You've got to stop paying out cash, so that dividend is gone, and you've got to cut your capital investment to try and start generating from your ongoing activities. And of all of these, one suspects the market is least impressed with the first. I mean,
selling assets.
Yeah, I mean,
who's going to buy them in the current market?
Well, exactly. Okay, Anglo, they might be hoping that someone else is better at running these things, but let's face it, it's a buyer's market right now. Who's going to say, well, I really feel like buying several billion in copper or iron ore assets at this time? And their big rivals like Rio and BHP are probably also cutting capital investment too. So the right kind of plan, but can it be delivered? And the market might be wondering, would it not have been easier just to raise equity?
Well, the shares are down about 10% today, which suggests that the dividend cut was long ago factored into the price. The asset divestments are probably also what the market has been calling for. Is the next step an equity fundraising, do you think? Is the company out of the woods on that score?
Well, it might be easier. I mean, you say in the woods, as it might, whether it's welcomed or not. Companies like Glencore, with a more concentrated ownership, were able to do this. And it at least meant it was easier to do than the death by 1,000 cuts of trying to sell assets, work things down, put them under care and maintenance, which means just leaving them sitting there because you can't find a buyer. So it may well happen, and it may well be easier.
Giles, thank you very much.
Thank you, Jonathan.